Welcome to Crypto Stock Lab.
All right, let's get right into it. What we're looking at here is a story that's, well, it's part mystery, part high-stakes gamble, and it is all centered on one of the most watched stocks in the EV space, NIO. Someone, somewhere, just made a huge move, and we're about to break down exactly why. 35 million. Now look, that is not just some random number on a screen. That is the exact number of NIO shares that one single firm just scooped up in a massive transaction. This isn't your average everyday trading. No, this is a whale making a very, very big splash. And that right there leads us to the single biggest question of this whole explainer. What in the world do they know that maybe the rest of us are missing? You just don't make a bet of this size, this close to a major earnings announcement, unless you have some serious conviction. So who's the mystery buyer? Well, it's a Hong Kong-based fund called Aspects Management. And the only reason we know this is because of something called a 13F filing, which forces these big funds to show their cards. But here's the kicker. It's the timing. The filing date is November 14th, but the big earnings call, that's set for November 25th. To make a move this big just days before a huge catalyst, well, that's a signal you can't ignore. You see, a bet like this isn't just a whim. The analysis we're looking at points to what it calls the triple threat catalyst. Think of it like three powerful forces all converging at the exact same time, creating what could be the perfect storm for a massive move in the stock. So let's break them down, shall we? First, you've got incredible performance and a clear line of sight to actually making money. Second, there's a huge pile of short sellers, which is basically creating an explosive situation. And third, and this might be the biggest one, there's a brand new sub-brand that could be a total game changer. Okay, so catalyst number one, it's all about the numbers. We're hearing strong reports that October deliveries smashed all-time records. But here's the really juicy part. The whispers among analysts are that Q4 of 2025, that could finally be NIO's first ever profitable quarter. And this isn't just from selling more cars, it's from selling higher margin cars from their new ONVO brand. More volume and better margins, that's the recipe for success right there. Now, for the second catalyst, let's throw another mind-boggling number at you. 153 million. That is the total number of NIO shares that people are betting against right now. It's the size of the bet that this stock is going to go down. And this sets up a huge risk for those short sellers. With 153 million shares betting against it, any piece of really good news, like, say, a surprise profit, could trigger a massive short squeeze. The source material literally calls this dynamite under the whole situation. See, the shorts are forced to buy back shares to stop their bleeding, which just throws gasoline on the fire and pushes the price even higher, even faster. It can get absolutely explosive. But really, the most important piece of this whole puzzle, the thing that's really driving all this, is the third catalyst. And it's all about NIO's new sub-brand, ONVO, and its first car, which is being positioned as a direct shot at Tesla's most popular vehicle. Now listen to the language the analysis uses here. It doesn't just say ONVO is finding new buyers. It says it is actively stealing customers directly from competitors. This isn't about growing the whole EV market. No, this is about taking a bigger slice of the pie from the guy who's already at the top. So you can really see the battle lines being drawn, right? NIO's strategy with ONVO is a direct assault on the market leader. They're aiming straight for existing demand with a car that also happens to bring in better profits. And for Tesla? Well, this creates a whole new headache. Suddenly, they're on defense, forced to protect their home turf. But to fight a war, you need a war chest. And the EV industry is absolutely brutal. It just burns through cash with these crazy price wars. This is where the analysis points to what it calls NIO's fortress balance sheet. Having a ton of cash on hand is a massive strategic advantage. It means you can afford to play the game, you can survive the price cuts, and you can outlast your weaker rivals. And this long-term thinking goes beyond just the balance sheet. I mean, everyone's worried about potential EU tariffs on Chinese EVs. Well, turns out NIO has a really clever plan. Instead of just shipping cars over, they're planning to set up local manufacturing partnerships right there inside Europe, probably for their smaller Firefly brand. And the goal here? It's to basically become a local European car company, completely sidestepping future tariffs. It's a brilliant move. So that's the fundamental why behind this whole thing. But what about the when? Okay, let's switch gears and look at the technical roadmap. The analysis lays out a super clear set of price levels that traders are watching like hawks to see if this whole bull case is about to play out. First up, we've got what the source calls the whale floor. This zone, right between 580 and $6, is seen as the big money buy zone. This is where you see those huge volume spikes, and it's believed to be exactly where that 35 million share buy went down. You could say it's the line in the sand. Next, there's the breakout trigger at $6.55. Now, this is the key level. A solid daily close above this price is the signal that the downtrend could finally be over. This is the green light that all the momentum traders are waiting for to pile in, and that could send the price rocketing higher fast. And finally, if we get past that, we hit the blue sky level at 750. According to the technicals, once the stock clears this hurdle, there is very little resistance left overhead. It's like a clear runway to push up towards those higher targets, maybe even in the $9 range. But you might be thinking, hey, isn't it too late? Is the stock already overbought? Well, according to the Relative Strength Index, or RSI, the answer is a clear no. The current reading is way down around 40, and you don't really hit overbought until you're over 70. So technically speaking, there is plenty of gas left in the tank for a run higher. And for the really big picture, the analysis points way down to the 200-day moving average, sitting around 494. As long as the price stays above that major long-term trend line, the overall trend is considered bullish, no matter how crazy the short-term gets. It really acts like a foundational safety net. So, when you put this all together, what do you get? You get a classic market showdown. On one side, you have widespread public fear, and on the other, you have this quiet, calculated, institutional conviction. The report basically argues that this entire setup is a classic bottoming signal. It's that textbook moment where you see tons of panic selling from the public being met with massive, quiet buying from what they call the smart money. It's the point where greed finally starts to wrestle fear to the ground. And this just lays the whole conflict out perfectly, doesn't it? While retail traders are panic selling on every dip, totally focused on scary headlines and fear, the big institutions are doing the exact opposite. They're just quietly soaking up all those shares, focused on the real fundamental catalysts we just talked about, and they're buying with serious conviction while prices are low. Which of course leaves us with one final critical question. You've got 35 million shares bought by a single firm. You've got a triple threat catalyst just around the corner, and you have this huge split between fear and conviction. So, are we looking at a classic bottoming signal right before somebody lights the fuse?